Life insurance. Between its death benefit and living benefits, life insurance has a variety of ways to help individuals meet their financial needs. Survivor protection. People buy personal life insurance most often to protect survivors, typically family members, against the financial loss associated with the insured's death. Common needs survivors face that life insurance can help meet include providing income for daily living expenses, retiring a mortgage or providing money for rent, setting up an education fund for the insured's children, paying off existing debts, paying final expenses, such as medical and funeral costs, financial security. Life insurance provides peace of mind to wage earners who want to make sure that surviving family members are taken care of in the event of their death. Exemption from creditors. Insureds find comfort in knowing their life insurance proceeds are paid directly to the policy's beneficiaries and are exempt from the claims of creditors, both the insureds and the beneficiaries. This protection is provided through the policy's spendthrift clause. Estate planning. In the broadest sense, estate planning involves planning for the distribution of all that one owns, one's estate, at death. In that sense, most people have estate planning needs. Life insurance has long played an important role in estate planning. Create an estate. When paid, a life insurance policy's death benefit creates an instant estate. This money can be used for any estate planning purpose, including covering the costs or taxes the estate may face upon the insured's death. Estate conservation. Life insurance is a useful way to preserve an estate, making it very popular with those who have substantial assets. Life insurance reduces or eliminates the need for a forced sale of assets to pay estate taxes, other costs, or debts the estate may face upon a person's death. In this way, life insurance conserves the estate, allowing it to be passed intact to the deceased's heirs. Avoid probate. When the beneficiary designation is properly established, death benefit payments bypass the probate process and are made directly to the named beneficiary. This makes it possible to set up special cash bequests that are outside the terms of an insured's will. Schools, colleges, philanthropic organizations, museums, or simply a favorite niece or nephew can be the policy's beneficiary. Key point. Life insurance death benefits may or may not be subject to federal estate taxation. It all depends on who owns the policy and the size of the estate. If the policy is owned by the insured, or the insured's estate is the beneficiary, then policy proceeds are included in the estate. Whether they are then subject to estate taxation depends on the value of the deceased insured's estate. While many people have basic estate planning needs, only those whose estates are valued well over $5 million have to worry about paying estate taxes. Personal uses for the life insurance cash value. Always accessible to the policy owner, the cash value represents a living benefit that makes permanent life insurance an especially valuable asset. Care must be taken not to abuse this benefit, since removing money from a policy's cash value will reduce its death benefit and weaken its funding if not replaced. Accumulate cash for living benefits. As permanent life insurance policies mature, they accumulate a cash value that represents a living benefit to the policy owner. The longer the permanent life insurance policy stays in force, the greater is its cash value. Available through a policy loan or partial surrender, in the case of a universal life insurance policy, the cash value may be used for any long-term purpose, including, but not limited to, paying for a child's college education, supplementing retirement income, serving as a source of funds in an emergency. Liquidity. Liquidity refers to the ease with which an asset can be converted to cash. Permanent life insurance policies are recognized as very liquid assets. The ease and relative lack of expense with which one may obtain the cash value is the key to permanent life insurance's living benefits. Key point. Policy owners must understand that the cash value is an integral part of the policy's death benefit and that withdrawing the cash value from the policy will result in a reduction in the death benefit. Perhaps the most important point for policy owners to understand is that life insurance is not well suited for short-term savings goals. Viatical settlements. In recent decades, Policy owners have started looking for ways to tap into their policy's death benefit when facing a terminal illness or permanent disability requiring long-term care. Insurers provide one solution, through the accelerated death benefit provision that is common with permanent life insurance policies today. A third-party alternative to the accelerated death benefit provision is the viatical settlement. Like accelerated death benefits, viatical settlements provide chronically or terminally ill individuals a sum of money, drawn from their life insurance policy, that can be used to pay medical expenses or to enhance quality of life. To set up a viatical settlement, a policy owner, the viator, sells an existing policy to a third party, known as a viatical settlement provider. These transactions are normally handled by a viatical settlement broker. Most states require such brokers to be licensed. The viatical settlement provider buys the policy with a lump sum payment, typically ranging from 50 to 80% of the death benefit, and is thereafter responsible for paying future premiums. Providers may also work with investors called viatical settlement purchasers who receive a share of the death benefit. Viatical settlements are generally available only to people whose policies are beyond the contestable period. Terminally ill or chronically ill. To qualify for a viatical settlement, the insured must be diagnosed as terminally ill or chronically ill. A terminally ill person has a life expectancy of no more than 48 to 60 months. The viatical settlement provider determines life expectancy based principally on the insured's medical records. A person is considered chronically ill if he or she needs long-term care assistance with at least 2 activities of daily living. A licensed healthcare practitioner must certify that this condition has existed for at least 90 days within the previous 12 months. Tax status. The Health Insurance Portability and Accountability Act, HIPAA, provides that funds distributed through a viatical settlement are income tax-free at the federal level. However, they may be taxable at the state level in some states. Fraudulent Viatical Settlements Model Act. To protect consumers, the National Association of Insurance Commissioners, NAIC, adopted the Fraudulent Viatical Settlements Model Act. Most states today have adopted some version of that Model Act. The Model Act codifies the rules by which viatical settlements may be advertised, sold, or set up. Among its key provisions, the Act requires viatical settlement brokers and providers to obtain a state-issued license before engaging in any viatical settlement activity. Defines fraudulent practices that are prohibited in the process of transacting a viatical settlement. See below. Identifies minimum disclosure requirements of what must be presented to consumers before a viatical settlement may be transacted. See below. Requires that interested consumers be provided with an NAIC brochure that describes the process of viatical settlements. Fraudulent practices. As defined in the Act, prohibited fraudulent practices, by a viatical broker or provider, include presenting, or preparing to be presented, false material information about the proposed viatical settlement. Removing, concealing, altering, or hiding from regulators the records of any person engaged in the business of viatical settlements. Embezzling, stealing, or misappropriating funds, premium credits, or other property of any party to a viatical settlement. Viatical settlement disclosure requirements. Viatical settlement providers or brokers must provide every viator with at least the following disclosures no later than at the time the application for the viatical settlement contract is signed. An explanation that there are possible alternatives to a viatical settlement. An explanation that some or all proceeds of the viatical settlement may be taxable. An explanation that proceeds of the viatical settlement could be subject to the claims of creditors. An explanation that receipt of viatical settlement proceeds may adversely affect the viator's eligibility for Medicaid. An explanation that the viator has 15 calendar days after receipt of the viatical settlement proceeds to rescind the contract. Life settlements. Like a viatical settlement, a life settlement involves the sale of an existing permanent life insurance policy for more than its cash value but less than its death benefit. Unlike a viatical settlement, a life settlement does not require the insured to be terminally or chronically ill. Instead, the only qualification requirement with a life settlement is that the insured must typically be at least 65 years old. Life settlement providers serve as the purchaser in a life settlement transaction. As the new policy owner, They are responsible for all future premiums and designate themselves as beneficiary. To avoid any appearance that the life settlement involves stranger-originated life insurance (STOLI), which is illegal in many states, life settlement providers typically require that the policy being purchased be past its contestability period. For your review, life insurance death benefits serve many important financial security and estate planning needs. Through its cash value, permanent life insurance provides living benefits that are available while the insured is alive through a policy loan, withdrawal, in the case of a universal life insurance policy, or surrender. This money may be used for any purpose. Withdrawing the cash value from the policy will result in a reduction in the death benefit if not paid back. Life insurance proceeds are paid directly to the policy's beneficiaries and are exempt from the claims of creditors. The purpose of a viatical settlement is to provide a chronically or terminally ill insured a sum of money that might be needed to pay medical expenses or to enhance quality of life. Life settlements are similar to viatical settlements but do not require the insured to be terminally ill. Please pause the audio and watch the video. You can restart.
Most of this course covers the what of life insurance. What is it, what's it made out of, and so forth. This lesson talks about the why. Why does a person need life insurance? Why do they want to buy the type of policy maybe that you're recommending to them? This particular lesson reviews the most common personal uses of life insurance, and there are many, and they are generally broken down into death benefit uses and living benefit uses, which were discussed in separate lessons. Living benefit needs are met either through cash value loans or withdrawals, or in the case of somebody with a terminal illness, access to a portion of the death benefit through an accelerated benefits rider. This lesson also talks about a developing area that I want to just take a moment to talk a little bit about, and that is the growing use of viatical settlements. A viatical settlement is really, at first glance, very similar to the accelerated benefits rider, but with a significant difference. Let's review again the accelerated benefits rider. With an accelerated benefits rider, if it's exercised, the policy remains the property of the policy owner, and to the extent that there is still some undistributed death benefit, that death benefit is payable to the beneficiary upon the insured's death. With a viatical settlement, that goes out the window. With viatical settlement, ownership of the policy is transferred to another party, the viatical settlement provider, who takes over ownership of the policy and ongoing premium payments. When the insured dies, it is the viatical settlement provider that receives any remaining death benefit that wasn't paid out to the policy owner when the policy was purchased. In fact, technically speaking, the entire death benefit is payable to the viatical settlement provider because, technically speaking, the viatical settlement provider pays the policy owner a sum of money which is not earmarked as part of the death benefit, but is simply payment for the policy. In other words, the policy owner sells the policy to the viatical settlement provider, the viatical settlement provider becomes the owner, and the recipient of the death benefit when the insured dies.